The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. This is Adam Welch here, joining you from Insurance Agency Marketing Services. Thank you very much for taking some time out of your Monday morning to join us here today. Today we're going to be discussing annual client reviews and more specifically conducting annual policy reviews with your clients that have enforced life insurance policies out there. So I'm going to take a look at a number of items surrounding that, but I should have a great presentation, so I feel it'll be very worth your while. But before we get into the topic of today's presentation, just do want to touch on a couple of housekeeping items. First of all, if you do have questions throughout the course of the webinar, please don't hesitate to type those in your question box on the control panel and send those over. Be glad to get those answered when they come in. Additionally, there are going to be a couple of poll questions. Your participation certainly greatly appreciated in those poll questions. Some relevant topics out there that we can certainly get some additional information out to you if that be of interest, and we can get that out to you very easily based on your participation in those poll questions. So keep an eye out for those. But with that, before we get into the presentation of annual client reviews and policy reviews with your life insurance clients, I want to make sure everyone in attendance is well aware of some great rewards, services, and incentives we have available for you to take advantage of when you work with us here at Insurance Agency Marketing Services. So with that, the first couple items I want to visit with you about are a couple of great business builders here. The first one being our Referred Producer Bonus Program. And this is a great program, a great opportunity to get some additional cash in your pocket. Just like you all out in the field, the most qualified lead you can receive out there is going to be a referral. I don't care how much you're paying for pre-qualified leads. A warm referral from an existing client is going to be the most qualified lead you could receive, and really a tremendous compliment as well. And the same holds true for us here at IAMS. So if you know of anybody out there that is working in the business but not working with us here at IAMS currently, if you pass their information along to us and make that introduction, we're going to reward you very handsomely for that, and want to encourage you to make those introductions. So how this program works, any referral that you pass along to us, once they get contracted with us, with any of our carriers, we're going to cut you a check right off the bat for $50 as a thank you for that contract. Once that referral starts writing business is really where you can start earning some additional cash there. And you can see here in this example, we're going to pay a 20 basis point override on the business that your referral writes with us. As long as they're contracted and writing business with us, you're going to get that referral bonus. So you can see in this example, if you were to refer over 3 producers, and each of those producers were $1 million a year producers each, just call it single premium life and annuity business, and the numbers are also prorated for target life, but that would equate to $6,000 extra cash in your pocket for doing nothing more than making that introduction and passing that referral along to us. So a great way to get some additional spending cash in your pocket there for doing nothing more than making that introduction. So please keep that in mind. Important to note that that referral bonus is not coming off the top of your referral's commission. That's coming directly out of our pockets to you. So please keep that in mind. If there's anybody out there you feel would benefit from working with us here at IAMS, certainly want to encourage you to make that introduction to us. Additionally, we do also have a great marketing reimbursement program that can allow you to potentially cut your marketing expenses in half. Simply put, this is a way to encourage you to write more business with us. The more you place with us here at IAMS, the more that marketing reimbursement account is going to grow for you to take advantage of. So just simple rough numbers here, basically per $100,000 in premium, be it annuity, single premium life, and prorated for target life, we're going to set aside $100 in marketing reimbursement dollars for you. So again, the more you write with us, the more that account is going to grow. And those marketing dollars are really there for you to use how you see fit. As long as the expenses are related towards building your business and marketing yourself, they're going to be eligible expenses. So send us the receipts for your seminars, client appreciation events. If you do a mail drop, or even need new business cards, send us the receipts for that, and we will cut you a check for up to half of those expenses based on what you have in that account. So again, a great way to potentially cut your marketing expenses in half. We do also have a great new producer bonus program, and this is really for those of you that are relatively new to us here at IAMS. This is an opportunity to reward you for the business that you write with us during your first 6 months of getting contracted with us. So how this program works, we have 3 different levels you can choose to cash in on. Based on the level of business you write with us in your first 6 months, be it 100,000, 300, or 500, that's all business from annuity, single premium life, and traditional life. Again, prorated for target life premium on the traditional life side. But once you choose to cash in at one of those levels, that's the new producer bonus. It's done. Once you cash in, it's over. But I have 3 great opportunities for you to take advantage of. So that $100,000 level, have 3 options to choose from. The most popular is going to be that $750 cash bonus, but you can also choose, if you don't currently have a website, we will create a website for you and pay the subscription for that for 2 years, or you can choose the latest generation iPad. If you have over $100,000 and can hit that $300,000 level, the rewards get a bit better. We have a Social Security marketing program that comes along with a 3,000-piece mailing to help get some additional leads. Also have an opportunity to jumpstart your marketing reimbursement account with an infusion of $2,000, or that $750 cash bonus increases to a $1,500 Visa gift card. Alternatively, if you can exceed $300,000 and hit $500,000 in premium in your first 6 months of doing business with us, we have a couple of other great business building rewards here with seminar systems from Matt Gill and Dave Pemper. Matt Gill and Dave Pemper are 2 elite producers with us here at IAMS, consistently qualify for all of our trips, consistent presenters at our Life and Annuity Academies, which we'll talk about here shortly. But they have built their business to the elite level that it is today around seminar marketing. Very strong testaments that seminar marketing still works. They've created their own seminar systems, both very different but very effective. So you can choose the system with Matt Gill that comes along with some tremendous coaching to deliver it effectively, and a 5,000-piece mailing to fill that room. And then, or you could choose the seminar system with Dave Pemper that also comes along with some fantastic seminar coaching to make sure you're delivering that properly, and that also comes with a 4,000-piece mailing. Alternatively, you could choose to customize your own vacation and customize your own getaway with our Ritz-Carlton Travel Rewards package. So that is our new producer bonus program, $100,000, $300,000, $500,000 level. Again, rewarding those of you new to us here at IAMS for the pieces of business you write with us during your first 6 months of doing business with us. Our back office support, this is something we really pride ourselves on and hang our hats on. We've been in business for 32 years, and that is in large part due to our commitment to providing the best service out there to the independent advisor. We know your job is not an easy one out there in the field working independently. There's a lot that falls on your shoulders that you have to be responsible for, and we recognize that, and we want to help shift some of that responsibility from your shoulders over to ours. So we want to help you be more efficient out there in the field, and we've designed our whole approach to providing what we like to call full support from submission to commission. So what that means is everything on the pre-sale side and sales support side, our annuity and life marketing staff will do a tremendous job in helping you with your case design and product selection and running quotes for you and illustrations for you, getting everything out to you that you need to write the case, along with some great tips on presenting that case effectively and presenting the solutions that are going to address your client's needs. From there, once the business is written, submit that application back into us. Be it annuity or life, we have a very talented team of case managers that will review the applications and scrub them for you to make sure they're going to be in good order before they hit the carrier to cut down on processing time. If you write a fully underwritten life insurance policy, we will actually schedule and order the exams and labs out of our office here for you. And then our case managers will continually follow up on that case with the carrier, make sure they're pushing it along and getting it processed as quickly as possible so we can get that case placed and paid as quickly as possible. So full service support from submission to commission there. We do have a tremendous creative marketing department here, and those of you that may have a need for some of these items, get some additional marketing efforts out there, be it printed or digital solutions, we have a number of options for you to choose from, including some turnkey options that are pre-written, professionally written brochures and flyers and some different marketing pieces that are ready to go, just need to be customized with your information, and then they'll be ready to hit the printer or be emailed out or mailed out to your clients, whatever you decide to do with that information. We also have agency solutions where we can actually assist you with your brand messaging and help you build a brand around your business with a logo, slogan, whatever the case may be, and get that information popped on brochures and business cards and any advertising materials you may have and currently use. We also have digital solutions available here, so helping you on the digital marketing front, everything from website creation and hosting to social media consulting and email marketing. We can assist you on that front as well. So if you're producing with us regularly, a lot of times many of these options are going to be available free of charge. Alternatively, if you're just getting going with us, we feel you're going to find our pricing to be extremely competitive with your local advertising PR firm that you may have used in the past. We're not in the creative business to make money. We're in the creative business to get your name and your message out there and get you in front of more folks so you can write more business, and that's where we all win. Our website, a tremendous resource out there. It is www.iamsinc.com. A lot of great information available on our website online. If you're in a pinch and it's after hours, or perhaps you have a weekend appointment and we're not available by phone and you need a term quote or an application, all those items are available on our website. We have our term quoting engine that we use internally here on the life side. Have our forms engine out there where you can pull down all the appropriate applications for whatever product you're going to write. We also have a tremendous sales resource library that in its own right has a wealth of information out there, from consumer-friendly presentations, some different calculators to use in your planning with your clients, depending on some different unique situations, as well as fact finders and even some white papers and marketing materials out there. So a lot of great information. If you've not yet gone out and registered for an account on our website, certainly encourage you to do so. Again, that is www.iamsinc.com. Our retirement analyzer software. This is a tremendous piece of software that we make available to contracted agents with us here, and it is free to those of you qualifying agents to implement in your business. But this is a pretty powerful tool that really goes a long way into illustrating the power of working with you and implementing your solutions to your clients. So it goes a long way to answer those 6 questions you see on the screen there, largely addressing the income concern and making sure that clients are going to be able to, retire on their terms with dignity and not have to worry about running out of money. So it'll show their current situation without working with you, and then implementing a few of your situations to help extend out their retirement income for their lifetime by implementing and work the solutions that you're recommending there. It also can illustrate the effects of an untimely death or a major health concern. So a lot of great planning approaches with that software. If you'd have interest in learning a bit more about the Retirement Analyzer, certainly encourage you to give us a call and ask to speak with Marcus Solar, who is our point person in the office for the Retirement Analyzer software. IAMS Wealth Management, and this is going to bring us to our first poll question of the day. Very simply, would you like to learn a bit more about IAMS Wealth Management? We have launched our own registered investment advisor here, and that is called IAMS Wealth Management. So we now have an outlet to help you get into not only your guaranteed fixed and fixed index annuity business and insurance business, but we also have an outlet to assist you on the fee-based asset management front. There are a number of reasons to consider getting into this side of the business if you haven't already. If you're currently working in the business and have a book of assets under your management, we have a great transition team that will help you transition that book of business over to our competitive platform. We feel you're going to find our fees and payouts to be extremely competitive out there in the RIA world. But a number of reasons to consider getting into fee-based asset management, and one of them is going to be increased revenue. Anytime you add an additional line of business, that's going to represent an additional opportunity for increased revenue. So these this line of business is going to take you more from the commission side and earning transaction-based commissions on your insurance and annuity business, and it's going to transition you to fee-based income. It's going to be recurring revenue, and the more you build your book of assets under your management, the bigger those fees are going to be, and it is going to be a recurring, predictable income stream. You're also going to see an increase in your fixed and insurance business as well. By being able to offer more services to your clients, they're going to see you as more of a, to be cliche, one-stop shop for them and for their needs. So you're probably going to see a nice increase in that business as well. It's going to go a long way into improving client retention and strengthening those client relationships, because you're going to be more of a holistic advisor and can offer more of a holistic approach for your clients. By also being able to offer fee-based asset management, instead of seeing that wealth management business roll down the street to the next advisor, more of that client's business is going to stay with you and your business. So I have a great opportunity to get you, if you're not currently in this business, get you up and running and up to speed, get you ready to take your Series 65 exam and get registered and get going in this business. So if you'd like more information, certainly encourage you to click yes on that poll question on your screen, and we'll get some additional information out to you. Alternatively, you can certainly give us a call and ask to speak with Charles or Mike in our wealth management department. They'd be glad to visit with you in a bit more detail about what we can do for you on that end of the business. But with that, I'm going to go ahead and close out that poll question. Thank you very much to those of you that responded. Next slide here to visit about is our Life and Annuity Academy, and this is going to bring us to our second poll question of the day. Very simply, would you like to learn more about our all-expense-paid Life and Annuity Academy? And clicking yes on this, just want to note that it's certainly not locking you into attending a meeting, but it's just letting us know that you're interested. We'll keep you on the list to be first to know about future dates as they become available, and we'll get some additional information about what these meetings entail. But I did mention this is all expense paid, so we will take care of all of your travel expenses from your flight, hotel, meals. All of that is on us. It just costs you a couple days out of your time. And we know that 2 days that you're spending with us are going to be 2 days that you're not out there in the field meeting with your clients and prospects, building those relationships and making those sales. So with that in mind, we're going to load you up with as much information as we can during these 2 days that you spend with us here. What these meetings are not, they are not product roadshows. We're not bringing in strictly carrier reps to talk about their product versus other products and why you should sell that product. While there is some product training involved, this is largely centered around sales and marketing and giving you some ideas and strategies and sales tools that you can take away from that meeting, take back with you to the office, implement in your business, and see a measurable increase in your overall production on the life and annuity side. So what's going to happen is we're going to bring out several of our top producing advisors, Matt Gill and Dave Pimper that I mentioned on the new producer bonus. They will be out there going over and giving a preview of their seminar system and talking about how they've implemented seminar marketing in their business to help boost their production and take it to the elite level that it is. Also have some other top advisors out talking about some different concepts ranging from infinite banking and private financing with life insurance to some unique trust products that we have available here and ways to incorporate that into your business to increase production. We'll talk about some different other marketing concepts and sales tools, including our retirement analyzer software, and touch on some of the software tools that we have available. We'll also talk about some different wealth transfer strategies, including single premium life, and how that can be another revenue stream to help you boost your production and make some more sales. So a lot of information is covered and thrown at you during those first 2 days, and our whole goal is to have at least one or two of the ideas presented really stick and resonate with you that you can take back, implement in your business, and see a measurable increase in your production. So if you'd be interested in attending one of these meetings, learning how we can get you out there, what the requirements are to be able to attend, I certainly encourage you to click yes on that poll question. We will be following up with you with some additional information. I usually hold 3 or 4 of these meetings a year, so do have several opportunities to be able to bring you in. But with that, thank you very much for those of you that responded to that poll question. We will get some additional information out to those of you that clicked yes. But with that, I'm going to go ahead and close that out and keep us moving here. So the final item I want to visit with you about before we get into the topic of today's webinar is going to be our 2019 Marketing Summit. Just recently made this announcement, got everything finalized with the location, and we will be taking qualifying advisors out to the gorgeous Ritz-Carlton Resort in Naples, Florida. It's going to be held August 25th through the 29th of 2019. We are currently in the qualifying period. The invitational period started January 1 of this year, and it runs all the way through June 30th of next year. And the great news about this is you can qualify with $3 million in total credits, total premium, but virtually anything you write with us is going to receive credit towards qualifying for that marketing summit. So you can see, $3 million in annuity premium, that's dollar for dollar, but we do have some advantaged requirements on the life insurance side. So single premium life can get you a little bit more than dollar for dollar credit, and target life premium again is prorated here. But the nice thing to point out again is anything you write with us, we are certainly appreciative of that. We want to show that appreciation by providing you credit towards qualifying for that marketing summit. Very excited about this location. Each one of these meetings has grown that we've held over the years. So I'm very excited to see that trend continue, and look forward to meeting everybody out there in 2019 in Naples. So with that, we're going to get into the policy review and annual client reviews, why we're all here today. So just a brief idea of what we're going to discuss here today. Start by taking a look at why perform annual client reviews. More specifically, life insurance policy reviews on an annual basis with your clients. We're going to explore why policy management is needed, and especially needed more today than ever before. We're going to discuss, of course, the policy review, how to conduct a proven policy review, and then talk about policy remediation, which is the great opportunity that could lead you to new opportunities and new sales. And a lot of times, new sales within your own book of business without going through and starting a new prospecting cycle from scratch. So first off here, why annual client reviews? Those of you that have been in touch with us here for any length of time, we're big on performing annual reviews and staying in front of your clients. A number of reasons why. Chief among them is going to be it's just flat out good customer service, not losing contact with your clients after the sale is made and moving on to getting new blood. Nurturing that relationship and keeping that relationship intact, retaining that business is going to lead to more business from that household. So it's good customer service to follow up after the sale, make sure everything is going according as planned, and making sure no adjustments are needed to keep everything on course. It's going to keep you in regular contact with your existing clients. It's going to keep you in front of your clients so they continue to view you as a trusted advisor. They're not going to forget your name and then, implement solutions from another advisor that could involve removing that business that you wrote. So it's going to keep you in front of your clients, keep your name there as a trusted advisor with your clients and with their household. Gives you a great opportunity to update your fact finder and update your clients on life-changing events. So depending on your client base, your demographic that you're working with, if there's been, a marriage, new child, new grandchild, or retirement, all of those present opportunities that could lead to more sales, new sales. Gives you an opportunity to update that fact finder with changes in insurance needs and to update existing insurance that may already be in force. Of course, it gives you the opportunity to, doing the annual client review, to do the annual policy review with your life insurance clients and manage that in-force life insurance with your clients. And then, of course, anytime you're in front of your existing clients, that is a time to ask for referrals. Do not be afraid to ask for referrals. Your clients have shown their trust in you by implementing solutions that you're presenting them. Keep providing that good customer service, and your clients should be more than happy to pass your name along to others in their network and help you grow your business from a referral standpoint. So why is policy management needed? And I always say policy management is needed more so than ever today, for a number of reasons. One is going to be innovation. In the life insurance product space has led to more complicated products out there. A lot of the innovation, of course, is going to be for the client's benefit. There's a lot of additional benefits, additional riders out there, but overall that product innovation has led to more complicated products that need to be managed and need to be watched a little bit closer. There's no more set it and forget it mentality out there with a lot of these products. It gives you the opportunity to monitor policy performance. And we're going to talk a little bit about that here in a moment, but making sure the policy is still performing as illustrated or closely to how it was originally projected. Keep an eye on the adequacy of policy funding, and this is really centered around universal life insurance and making sure that policy is adequately funded, there's enough cash value in that policy to keep it afloat. Today's insurance is no longer really just insurance. You're not just selling a death benefit in many instances. A lot of times there's a concept that's being sold, and life insurance is just the vehicle. And with those concepts in mind, and life insurance being the vehicle, we really want to make sure that vehicle is tuned up and running as efficiently as possible to make sure that the concept that was sold, be it overfunding a life policy for future retirement income, for example, is that concept is still going to pan out and be able to provide the solution that was originally presented. So keeping an eye on the policy performance and the concept to make sure that concept is still going to be around is just as important. And then, of course, you have the opportunity to monitor carrier stability. Things can change sometimes with carriers' financials, and making sure that that policy is issued by a strong carrier that is going to be able to keep that policy and keep their promises. So we talked about innovation leading to more complex and complicated products. And here on the screen is kind of an evolution of life insurance. And this isn't meant to be chronological by any means, but more so showing you the evolution of insurance that is kind of shifting the risk more to the client's end here. So kind of starting off, in the early days of insurance, we know whole life insurance was the king. Still, is certainly a very big player out there today. But whole life insurance, that is insurance that's supposed to be there for your client's whole life. Strong guarantees built into it. Basically, your client pays the premium payment, that insurance is guaranteed to be there. The cash value performance and the dividends, whatever the inner workings of that whole life policy may be, that's going to fall on the insurance company to manage. Make sure that the insurance company's investments in their general account are performing and providing the returns needed to back up the guarantees they're providing with that whole life insurance. Really, the only level of risk that fell on your client's shoulders with whole life is making sure that the premiums are paid on time as scheduled in that policy, so that death benefit is guaranteed to be there. Fast forward a little bit, and we have the introduction of universal life. Universal life insurance, obviously around today, a lot of innovation with that, and presented a lot of opportunity to make life insurance a more relevant aspect of everybody's plan out there. There's a lot of flexibility that came with universal life, but with that flexibility, the insurance companies had an opportunity to shift more of the risk of that policy onto the shoulders of the policy owner and not as much on the insurance company's shoulders. So universal life gave the flexibility for adjusting the death benefit and premium funding levels. As long as there's cash value in the policy, that policy is going to be in force. The client didn't want to pay premiums one year or didn't want to pay the full premium that was illustrated, that's fine. As long as there's cash value in the policy, it'll be afloat. The interest rates were declared by the insurance company. So, talking about basic current assumption, fixed universal life, where the insurance company declares an interest rate on an annual basis. Backing up that interest rate, the insurance company had to make sure their investments were in line to be able to provide those crediting rates. We have the introduction of index universal life insurance now, and same concept, still have that flexibility with death benefits and funding, but more control about how the policy can perform and how interest is earned was now shifted to the policy owner and less on the insurance company. So index universal life, we have a number of different crediting strategies, from the annual point to monthly point, and multiple index options to choose from the S&P 500 to the Dow and NASDAQ and Russell 2000, and even some proprietary indexes that have been introduced out there as well. So number of options to choose from and how interest is going to be calculated and credited to the policy, but more of that falls on the shoulders of the policy owner to make those index strategy allocations. And if changes were needed, it's going to fall on the policy owner for that cash value versus the insurance company. And then the same concept with variable universal life. Same concept as IULs. Variable universal, you have the mutual fund sub-accounts that the policy owner can choose from to allocate the cash value and premiums, and needed to monitor the policy performance and those underlying sub-accounts performance to make sure that they are performing and providing the returns that were projected, to make sure that cash value is going to be there. With VUL, there's a lot more fees involved, fees from the mutual fund sub-accounts and policy fees and things of that nature. So there's a few more moving parts, but again, more of the risk was shifted from the insurance company shoulders to the policy owner. So again, with innovation in life insurance, more complicated products, more moving parts, great upside potential for clients, but also presents the need for significantly more oversight and management on the policy owner and really agents aspect as well. So getting into the review. So when you're doing an annual client review and reviewing in-force life insurance with your clients, whether it's something that you sold them or somebody else sold them, there are 4 main review categories we want to really key in on here. And the first is going to be policy funding. And this is referring to the amount and method of premium payments. With universal life, there, as I mentioned just a slide ago, as long as there's cash value in the policy, that policy is going to stay in force. But if we run into a situation where the client just decides to stop paying premiums, again, they have the ability to do that as long as there's cash value. But if that policy is not performing adequately, it may need additional cash out of pocket from the client. So keeping an eye on policy funding and making sure that the premiums paid are going to keep that policy going. That kind of goes hand in hand with monitoring the policy performance, taking a look at the interest rates and how cash value is being credited, how that cash value account is growing. Also taking a look at charges and fees with your variable products. And then identifying policy loans. Are there loans outstanding? If so, what's the overall impact on the policy? We'll talk about this here in a little bit, but a lot of the concepts today, especially around universal life and index universal life, is going to be selling these policies to be overfunded to supplement a partial tax-free income during retirement. And that income during retirement is going to come via policy loans most often. So making sure that policy loan's not growing too large and going to grow near the actual cash value in the policy that could force a policy lapse, making sure those policy loans are not hindering the policy too much and going to force a premature lapse. Also taking a look at the carrier stability, just doing a check rate of ratings and making sure that carrier is going to be there to follow through on their promises, be it paying those loans out for the tax-free income during retirement and paying the death benefit claims to your client's loved ones to leave that legacy. So the first step in any policy review is going to be to obtain data about the policy. And really we're going to key in on just kind of general items here between universal life and whole life, 2 main prevalent type of life insurance out there right now. So the first two items I have stars next to, and these are going to be the absolute bare minimum to do a prudent policy review, the bare minimum pieces of information we would need for both product types. Ideally, we would have an annual statement or a current policy data page provided by the carrier, and would also have a current in-force illustration that is going to reflect the current funding at the current crediting rates, interest rates, illustrated rates, whatever the case may be, depending on the type of policy, and then the current cost of insurance scales. So referring to that as the current illustration. At minimum, those two items would be needed to take a look at the policy, take a look at the current cash value, and see how the policy is going to be projected to perform from today, continuing on under the current scenario with your clients paying the current premiums. Ideally, we would also have a couple of alternate funding illustrations, and this would give you the ability to have a much larger conversation with your client about potential avenues you could take with that policy. So looking first at universal life, in addition to the current illustration, the current premium paying illustration, we could request an illustration, alternate illustration from the carrier showing suspended pay. So if the client were to cut off premiums today, not pay anything more out of pocket for the rest of the policy, how long would that policy stay in force? Alternatively, if the policy is projected to lapse prior to maturity under the current funding situation, we could request a minimum to mature illustration, show what that premium would need to be increased to keep that policy in force to its maturity age. Similar type of story on the whole life. Whole life, we have some different ways of funding. While premiums have to be paid, there are a couple different ways we can look at it. So in addition to the current in-force illustration, we can still have a suspended outlay illustration where the client no longer pays premiums out of pocket, and that would perhaps involve using premium loans to pay the premiums, or an alternate dividend use. So a couple of different situations for that whole life policy. Again, there's not as much flexibility with whole life, but there are some different ways to pay the premiums and some different ways that we can accomplish some different concepts with whole life insurance. So those are the pieces of data that ideally we would have for the policy review to be able to do a good job and really get a gauge on how that policy is performing. At minimum, again, just to reiterate, the annual statement or current policy data page from the carrier, and then the current illustration reflecting where the policy stands today. So digging in a little deeper to universal life, and I'm going to do my best to keep it fairly high level here and not get too into the weeds, but really the two areas we want to look at with this policy once we have that data is going to be a review of the funding. So taking a look at that current in-force illustration and seeing how premiums are currently being paid, what level of premiums are being paid, and what mode, be it annually or monthly. How is that policy funded? Is it underfunded? So are we seeing on the non-guaranteed side, and guaranteed for that matter, are we seeing a lapse prior to maturity age? A lot of times, with the exception of some of these older policies that may have maturity dates of 95 or age 100, a lot of times the new policies today are going to be sold on the new mortality tables that run to age 121, and that's going to be the new maturity age. So with that in mind, a lapse prior to maturity may not be the worst situation in the world, but we want to dig a little deeper and see at what age, if that policy is going to lapse, what age would that be? See if there's a probability of the insured actually outliving that coverage. Is the policy adequately funded, meaning it's going to stay in force to maturity or desired age, perhaps mortality age? Is the policy overfunded? So there can be a situation where it's overfunded. Of course, if we are looking at a tax-free retirement sale, yes, we want to overload the daylights out of that to get that cash value up so it can perform optimally there. But perhaps it's a no-lapse guarantee policy, and there's a lot of cash value in that no-lapse guarantee policy. Could we possibly cut back funding when the client's just concerned about death benefit and provide that death benefit on a more cost-effective basis there. So it is possible for the policy to be overfunded and cut down premiums. With a look at the funding, we also want to review the performance of the policy, and funding and performance really kind of go hand in hand, especially considering universal life. So universal life, when that policy was initially sold and illustrated, it very possibly likely would have shown the policy staying in force to maturity with a lot of cash value, but over the years, maybe there was a change in crediting rates or cap rates. The index options, for example, on an IUL didn't quite pan out, didn't earn the interest rate that was originally projected and illustrated, meaning the policy is underfunded. Even though the client may be paying the original premiums that were originally projected, may have to increase that funding a little bit to get it back on track and get that cash value back up to par. So performance and funding kind of go hand in hand here with universal life, but just keying in on the performance, we want to look at the current crediting rates if it's a current assumption policy, fixed policy. Take a look at that current interest rate that's being credited, compare that to the interest rate that was projected at the time of issue. Also look at the cap rates if it's an index universal life policy, and look at participation rates, see how those are doing compared to when the policy was originally sold. Have they changed? Have they decreased or even increased? Take a look at the changes from issue and the changes from the prior review that was completed. Also taking a look at cost of insurance. So this can be a bit more intricate to get into and determine if there's been any changes. There can be minor changes and kind of go undetected, and a great way to kind of sniff those out is if the crediting rates and cap rates and performance is all performing as illustrated, but the cash value is suffering some in that current review. Maybe there has been an increase in COIs or the policy fees out there. So keeping an eye on the charges, certainly a key component of the performance review. And then again, hitting on policy loans. Are there loans outstanding, and what's the overall impact on that policy? Make sure those loans are not growing too much. If they do start approaching the cash value, that means a lapse is probably going to be imminent in the near future, so it may be time to start at least paying that loan interest and start repaying some of that loan to keep that policy going. With whole life policies, we're looking at really the two same areas. We want to look at the funding of the policy, and we want to look at the performance of the policy. So reviewing funding with whole life, again, traditionally with whole life, not a lot of flexibility in terms of premium payments and death benefit changes. It's more of a kind of what you see is what you get type of product. Those premiums have to be paid to keep that coverage in force. But it is possible that the policy could be underfunded and need some increased outlay with some of the additional riders and features with whole life policies, like term riders. A lot of times, if those term riders switch to an annual renewable type of term rider, that term coverage could become significantly more expensive than what was originally projected, meaning in order to keep that full death benefit coverage, if it's still needed to pay for that annual term component, going to need to pay some increased out-of-pocket expenses for that. Is the policy adequately funded? Meaning no outlay changes are projected. The policy is going to keep going on that current illustration, and the carrier is not projecting an increased and out-of-pocket outlay from your client. Again, taking a look at performance, going to go hand in hand with the funding of the policy, but here, instead of reviewing the crediting rates or participation rates and things of that nature with universal life, here we want to look at the way whole life policies earn interest, and that's dividends. So taking a look at dividend scales. Has the carrier been pretty consistent with their dividend scales and their actual crediting rate for those dividends with that policy? Or maybe the dividend scales have been tail back a little bit, and dividends are not as high as originally projected. Also, reviewing how the dividends are being used. So whole life policies traditionally give you some different options, of course, depending on the carrier and the product, but typically you have many different options of how you put those dividends to work. They could most often be used for purchasing paid-up additions. And paid-up additions, it's just additional paid-up insurance that's added to the death benefit and cash value. That dividend is going towards that death benefit, so you could see an increasing death benefit based on those dividends. Alternatively, dividends can also potentially be allowed to accumulate at a specified interest rate, paid out to the policy owner in cash, or put towards the premiums to reduce the actual premium, out-of-pocket outlay for the client. Pardon me. I'm fighting a little bit of allergies here, so bear with me. But taking a look at dividends, that is the method of interest for whole life policies compared to crediting rates with universal life policies. Also, what riders are on the contract. Most often we're going to see some term riders, so that policy was perhaps originally sold with a base whole life death benefit portion, and then a term portion can be a very cost-effective way to purchase the coverage that's needed. But as I mentioned up there above in the funding review, those term riders can potentially expire and switch to an annual renewable term, becoming significantly more expensive, requiring more outlay from your client. And then again, loans. We're going to see loans more often than not with whole life policies. I've seen a lot of different scenarios. I know back in the 80s and 90s, some companies were very big on the quote-unquote vanishing premium concept, and sometimes that concept really didn't pan out. So it may have been originally projected that while the policy matures at age 100, where the policy actually becomes paid up at age 100, perhaps it was only projected that the client would need to pay out of pocket for that policy for 20 years and then no further outlay needed. And that's because that a combination of the surrender of policy values and dividends were going to be sufficient at that point to pay premiums. So if those situations did not pan out, if the dividend scales were not as great as originally projected, or the policy didn't perform as originally projected, then there could be a need for additional out-of-pocket premium. Otherwise, if the client decided to hold true with that, in this example, pay until year 20 and then suspend out-of-pocket premiums, that premium is still going to be due. So if the dividend is not enough to cover the whole premium and the client doesn't send in the check for the remaining premium, then a premium loan is going to be taken out to pay the premium for that policy and keep it in force. Kind of a non-forfeiture option with the whole life policy. So making sure that that concept is going to pan out if that's the case. If not, if there's loans, reviewing the impact on the policy, making sure, again, those loans are not growing more than the cash value to force a policy lapse. And then term, just to hit on quickly, even if you have a lot of term insurance on the books with your clients, still prudent to be in touch with them on an annual basis or a couple of year basis, at least in regards to that term policy. But a few items to take a look at for term. While there's of course, less moving parts with term coverage, we don't have to worry about cash value. We really don't have to worry about funding adequacy because there's no cash value component. We still need to make sure that those premiums are being paid. We're not in the grace period. We want to look at the premium competitiveness. So maybe a term policy that was sold 3 years ago, there's been some changes in rates now, and perhaps we could get that same level of coverage on a new term for less premium. Certainly a possibility out there, and if insurability is still there, it would make sense to get into a new term coverage option based on that premium competitiveness. Taking a look at the level premium guarantee, simply put, the term period. Is it a 10-year level premium, 15, 20, or 30? Where are we at in that level premium guarantee period? If we're nearing expiration, then we need to start looking at our options and doing a needs analysis. Do we still need this whole coverage? If so, all right, let's look at insurability and ability to pay premiums on an ongoing basis and see if perhaps a new term policy would be sufficient, or do we need to look at something a bit more permanent? Also, keeping an eye on conversion privileges. A lot of policies out there are going to have conversion privileges, which allows a portion or all of that term coverage to be converted to a permanent plan without providing evidence of insurability. Many carriers put a time limit on when that conversion can actually occur, when it can take place, be it 5 years from the date of the policy or to a specified age. Want to keep an eye on where that conversion privilege expires, if it does expire, to make sure we're taking advantage of that. A lot of times we'll see advisors come to us with cases on, young professionals kind of getting started in their career, can't afford the level of coverage they need for their families on a permanent basis just yet. So look at getting into a term policy as a starting point, lock in their health when they're young and getting started, and then look at converting down the road after their careers kind of take off in income and earning potential increases, where they could afford the permanent coverage that they need. So keeping an eye on conversion privileges, especially in those scenarios. So findings of the policy review. So we've gathered the policy data. We've taken a look at the illustrations and statements. What have you found with that review? Is the policy going to lapse prior to maturity? Is there a loan on it? Those would be findings of a troubled policy, which should really start to trigger some red flags in your mind to start exploring some remediation options to address that troubled policy, whatever the issue may be. So if it's underfunded, there's an untimely lapse, perhaps we need to make some changes with the funding or death benefit level. Is it overfunded? Perhaps there's a more efficient use of the funds, so we could reduce the premium payments and use those other funds more efficiently, be it increasing contributions to retirement accounts, whatever the case may be. Is the policy underperforming? Is it not competitive with other similar types of policies out there from other carriers? So doing a little bit of a competitive analysis, comparing that in-force plan with what's available today. Have the COIs increased since the policy was issued, which would have a significant impact on the cash value? Are those fees more expensive than competitors, making it a non-competitive or lacking competitive plan? If any of those findings are uncovered on that policy review, then remediation options should be discussed. So this is not an all-inclusive list. This is more so looking at remediation options for universal life policies. So they're going to vary based on the type of plan, but what you see here on the screen is generally going to be available for universal life policies. So one is going to be increased funding. If the policy is underfunded, it's going to lapse prior to maturity. Look at the client's first needs analysis. Is that level of coverage needed? If you identify yes, it is, how about their willingness and ability to increase funding? If it's there and that coverage is needed, then explore that opportunity to increase the funding to that policy. Alternatively, if the level of coverage is not needed, that full level of coverage, maybe we could look at decreasing that face amount. Since we have that flexibility with universal life, look at decreasing that face amount within tax compliance constraints and make sure we're not going to get into a MEC issue or perhaps a definition of life insurance issue. Make sure it still qualifies as life insurance, but explore decreasing a face amount of that policy. Third option could certainly be a combination of the first two. So decreasing the face amount and increasing funding a little bit if that policy was severely underfunded, and that funding would still be underfunded based on the decreased face amount. You could explore a combination of the two. The fourth item would, of course, be a replacement. Explore 1035 exchange. Maybe the policy is not as competitive as it once was, and there's some more competitive options out there in the marketplace today. If the client is still insurable, their health status really hasn't changed, then it could be prudent to explore 1035 exchange. Take that cash value out of that old policy and exchange it into a new policy with a new premium payment and new coverage. Or if the coverage is no longer needed, you could certainly explore cash surrender of the policy and don't run into a situation where that policy is going to run out of cash and lapse and then have nothing to show for those premiums that are paid. Explore surrendering that policy for the cash value, eliminating the premium payment, and then putting those funds to more appropriate use, whatever the case may be. In any situation, when you're evaluating the remediation options, any of these options are going to require a suitability analysis, a needs analysis, and kind of health analysis to see if insurability is there, what is their current insurance need. Do we need that full level of coverage? Could we get by with a little less, or perhaps do we need more coverage? So doing that type of analysis at the time of review is certainly prudent, especially when you're dealing with potential remediation options for that policy. So I have a couple of case studies. We are coming up on our time here, so I'm going to move through these fairly quick, but I do have a couple of case studies just to kind of get your minds thinking about some different opportunities that very well could be sitting in your book of business if you have any life insurance clients out there. So the first scenario we're going to look at is a 67-year-old male. Currently has an older fixed current assumption universal life policy. Relatively large policy at $1.2 million face amount, and the gentleman is paying $23,000 out of pocket on an annual basis here. So the advisor went through, gathered the information, gathered the illustrations, did a quick review of the policy, and found that the crediting rates on that policy have since decreased since policy issue and decreased down to the guaranteed minimums since policy issue. So with that decrease in crediting rates, while he was paying that $23,000 that was originally projected, that funding is no longer sufficient to support the cash value. As as we age, cost of insurance grows, so that cash value is decreasing rapidly. No longer funded appropriately. There's a lapse projected prior to maturity unless the client starts paying more out of pocket. So the solution here, advisor did a needs analysis and found that full $1.2 million not really needed anymore, given the client's age, has kids off and on their own, adult children out of the house, could get away with a lower death benefit amount that would be more suitable. Client didn't want to increase funding and actually wanted to get away from paying premiums out of pocket if at all possible. So what the advisor looked at was a 1035 exchange, salvaging that remaining cash value and moving it into a single premium life product. So a great opportunity to get a paid up policy using a single premium that was already in an existing policy, and the advisor now eliminated the ongoing funding requirement with that policy because it is single premium. It's a paid up plan, guaranteed to be there when the client needs it. No further premiums are due, and it's a more appropriate level of coverage than that $1.2 million. So a situation like that where the client doesn't need that full face amount, really doesn't want to pay increased premiums, and really wanted to eliminate that $23,000 a year payment if at all possible. This was a great fit to address that client's needs and free up that annual premium commitment. The second one we'll take a look at here quickly is a 52-year-old female. So again, we're looking at an older fixed universal life policy, a $500,000 face amount, paying $8,500 a year for. Findings similar to the last one, decrease in crediting rates since issue. Common story that I see here personally with a lot of advisors that are bringing some of these cases to me. Some older universal life policies that are starting to implode. Crediting rates have decreased significantly since issue. So that's why, it's really kind of keying in on this. There's a lot of these opportunities out there, a lot of these policies that are in trouble right now because of a decrease in crediting rates. Also, this one happened to be with a carrier that had to increase cost of insurance for whatever reason, and this lady's policy was subject to that cost of insurance increase. So kind of have a compounding issue here with the decrease in crediting rates, and now the company is charging more for that life insurance policy. That cash value is really starting to suffer. The policy is really in trouble here. So after reviewing the policy with a client, doing a needs analysis with the client, identified that $500,000 death benefit still needed. Would like to maintain that if at all possible. She's still working, earning a good living, and has the willingness and ability to continue paying premiums. So with this, looking at salvaging that remaining cash value again. And since that full coverage is needed, it's not going to be enough to support that in a single premium policy. So we're looking at 1035ing that into a new policy, and more specifically one that has a no lapse guarantee feature. The client did not want to be in a situation again where the policy is going to implode and run out of cash value and lapse. Wanted to make sure that policy was going to be there regardless of what happened. So exploring a 1035 exchange into a guaranteed universal life policy. In this scenario, the policy is guaranteed. As long as premium payments are paid on time and in full, that death benefit is going to be there regardless of what happens with the cash value. A lot of times these no lapse guarantee policies are not even designed to maintain cash value. So while you do forfeit the flexibility that comes along with universal life, you do have some guarantees that traditionally would be found with whole life policies, but on a more cost-effective basis in a no-lapse guarantee universal life policy. The death benefit-oriented product, again, that better aligns with the client's goals of maintaining that level of coverage on a guaranteed basis. So just a couple of case studies there. Hopefully get your wheels turning about some opportunities that very well could be existing in your own block of business. But at the very least, hopefully I didn't scare you with life insurance and some of the ongoing oversight that I feel is very necessary with life insurance, but doing policy reviews and doing annual client reviews with your client base certainly important out there. So I hope at the very minimum, if you're not already doing annual reviews, just touching base with your clients once a year and making sure nothing has changed. Take that step in your business. And I certainly believe that you're going to find providing that higher level of service is going to keep that client satisfied with you and keep you as a name that they're going to come back to if something does change. But certainly encourage you to get on board with doing annual reviews and more specifically doing policy reviews with your clients. At this point, our last minute or so here, I'll take a look here for questions, but we'll go ahead and close this out. So I'll be following up with everybody here shortly after the webinar. See if there are questions. Be glad to visit with you in a bit more detail about doing annual reviews and visit with you about some opportunities that could be lying in your own business. But I do appreciate everyone's time here today. And looking here, we are over our time. So I'm going to go ahead and close this out. But thank you again, everyone, for spending part of your Monday morning with us here. I will be following up with everyone. Until then, have a great rest of your Monday, great week, and look forward to speaking with you soon. Take care.